I'm going to start streaming now. Okay, good morning. Today is June 18, and we will continue with chapter 18, with chapter 8, and we will do one more practice like what we promised on Thursday. We're going to do one bank reconciliation, and then we will continue with chapter 9. All right, and so let's go to chapter 8 on the book, and we will pick, let's see, we're going to pick a problem. All right, problem 4, chapter 8, problem 4, which is page 329. Page 329. Got it?
Yes, sir.
All right. The following information is available for Sedona Company as of May 31st, 2014. So the requirements are, number 1, prepare a bank reconciliation. You see that in the bottom? The requirements? Prepare a bank reconciliation for Sedona as of May 31st. And I'm not sure if we're going to do number 2, but we will do 3. All right? So, let's go to, so we can demonstrate to the other ones who are not present. The first thing is we're going to do what? Put the title, yeah. So, what's the name of the company?
Sedona Incorporated.
Sedona Inc. Incorporated. INC. And then beneath that, what do we put? The name of the statement. Bank reconciliation. Bank reconciliation. Bank reconciliation, and then beneath that we put the date, which is May 31st, 2014. All right. Do you remember from last time what is the first thing? What is the first component of the bank reconciliation?
The balance per bank.
Yes, sir. Okay. Balance per bank. Let me go one more down so we won't be a little bit far from the title. Balance per bank. And how much is it? How much is the balance per bank? Look in the those statements A through I. How much is the balance per bank?
A through I, let me see. What would be
I see it.
the first one, right?
Yeah.
$42,754.16.
No, that's not the one. Well, that's the books. We need the balance per bank.
Okay.
Read the whole sentence.
Cash on the bank statement.
Yes.
Today was $52,351.46.
All right, that's correct. 52,000. 351.46. Okay, let me put all of these as dollars. All right, and then we will. Okay, where is the dollar sign here? Here it is. This is going to be a dollar. F2. And this one is not going to show. Anyway, that's a dollar. Okay, and then what's the formula says? Balance per bank.
Equals,
What do we, remember we have addition subtractions yet.
yeah,
We
we
forgot
got
what do we add?
deposit, like add that in the deposits.
Deposits in transit, correct?
Mm-hmm.
Now, do we have deposits in transit?
Yeah.
Do we have a deposit in transit? How much is it?
$5,220.94.
Yes, sir.
But it
So-
says it did not appear on the bank statement.
Yeah. That means we deposit in transit. Yeah, what does it say? It says what? A deposit of 50 representing cash receipts or method did not appear on the bank statement. That means it's in a transit.
Yep.
Yeah. So we're going to say add deposits in transit. And how much is that?
$5,220.94.
Let me put this one right here. 5,220.94. Correct?
Yes, sir.
All right. And then what else is in the transit? Or something, or some, if you look, remember, see, we look at the cash receipts, and if any check that has not been added to the balance is
Outstanding check.
no, not outstanding, is coming in.
Oh,
That's addition.
yeah, okay.
Yeah, that's addition. So do we have any of those? Or do we have any errors that we made or anything unusual?
It says a check for
Uh-huh.
$1920.
For how much?
$1,920 was returned with the statement was recorded incorrectly in the check register as $1,380.
That's
That's an error, right? Yeah. That's
okay.
D.
A deposit and outstanding checks. A check 19 returned with the okay. So what's the difference between the two? Between these two?
Talking about what they're talking about.
Yeah.
in D?
It is returned with the statement was recorded incorrectly in the check register as 1,380.
So they wrote the check for too much or something like that?
Yeah. So that means we need the money back. So how much we need back? It's supposed to be 1,380, but it was written for.
1920.
So how much is it?
Subtract those.
What's the difference between the two? Well, I guess let's wait on this one, because that doesn't have to do with this is something out. It's not in. Bank service charge, no. Bank collected 12, no. NSF check is not in this. The bank mistakenly charged to the company's account a check for $850 drawn by another company. So that's a check that makes sense here in this case. It should not be written in the first place. So you have to put the money back. So what do we call that? That looks to me that comes in this category.
Okay.
Yeah. So it's a mistaken check. What do you want to call it? Mistakenly written check. Let's say mistakenly or a mistaken written check.
Okay.
Okay. mistaken written check. All right, for how much was this?
$850.
$850. Exactly? Yeah.
Yes, sir.
So now, do we have anything else to add? Based on what I have read, nothing else, yeah. So the total of these two things is what? If I put a line, let me just go to here, F2, and put a line under it,
So
and we get a total of what? These two things. $6,070.
$6,070.94.
Okay, like that. $6,070.94.
Yeah,
Now, what is the subtotal now
the subtotal.
of these two things? These two things. It didn't do. Add these two things for me. 52, 351, 46 plus,
Is
bless you,
Thank you.
$6,070.90. What do you get?
$58,422.40.
All right, so this is our subtotal. All right, now we're gonna, let me put a line under that. Okay, now we come to the second component for the balance pair bank. We do that, now what?
The less outstanding.
Yes, sir, the deduction now. All right, so we're going to say here, less. Do we have any outstanding checks?
That would be the one. Outstanding checks total $3,900.
Yes, sir. Less outstanding checks. How much their total? 3,000?
$3,936.80.
Point 90. Point what?
Yeah.
Point-
3,000.
Point 80.
$3,936.
Point 80, yeah. All right. And let me put a line under this one. So 58,422.40 minus 3,936.80. What do we get?
54,485.6.
54,485.60. All right, so let me put a line under this one, and why am I getting a line under this one? It's all right. And this one, I'll put a line under it. This is what now?
Another adjusted balance.
Yes, sir. Adjusted balance per bank. Adjusted or corrected? Adjusted balance per bank. All right. Let me do this here, so make it looks better. And now where can I combine this? I need to combine these two.
Bless you.
Thank you. Excuse me again. Now there is a where we can combine the lines. What is that thing? Merge sales and center. All right, and the same thing for that. Merge sales, and date also. See, it looks better now. Okay, now we come to the second component, balance per books. All right, balance per book. How much is it?
Balance per book. 42,754.16 cents.
42,754.16, correct? All right. Let me put this as a bold, so they will be recognized, and the adjusted balance also a bold, so it will be recognized, and bold. All right, so what is the first thing come under balance per books? We look for the collections made by the bank. Now, what did the bank collect on behalf of Sedona Company? So we add
$12,360.
what does that mean? Say it again one more time.
$12,360. That's on F. The bank collected $12,360 for Sedona on a note.
Okay, which item is that?
It's F.
The bank collected 12,000. Oh no, the face value of the note was, so you got to separate
Oh.
the face value from the interest.
Oh, okay.
Okay,
So,
so,
so we're gonna put 12,000. So we're
note receivable, yeah. So we're gonna do add note receivable. Okay, note receivable collected by the bank. How much is it? 12,000, correct?
Yes, sir.
Nope.
But the bank collected
Yeah,
more than, so we don't count in the interest the bank collected.
we're gonna put it in a separate line.
Oh.
Yeah, remember we put it in the separate line, and so we're going to call interest on the note. Interest on the note collected on the note receivable. How much was it? $360. $360. All right, and what else we can add? Notice on I see the bank reported that it had credited the account for $120 in interest on the average balance. So that's the interest. See the difference between this interest? This one is on the note, and then we have to separate the one on the account. So we call that interest what? You can say interest revenue if you want, but I'm going to call it interest on the balance. Interest on, I'll just call it interest revenue. Interest revenue for $120. Okay, So what is the subtotal now? Let me put a, see if I can put a line under this, if it will allow me. It sure did. And the subtotal, what are the total of these three things, first of all?
Okay.
These three things total what?
12,480.
How much?
12,480.
408 exactly?
Yeah, yes, sir.
All right. So add the balance, this one, 42,754.16, and the total of these additions, we get the subtotal, which is the subtotal
55,234.16.
how much? 55,234.16.
55,234.16.
All right, now we gonna look for the subtractions now, the deductions. All right, and then therefore we're gonna say less, or you say deduct. That'll be fine.
Miscellaneous.
Less. All right. Now we looked at several things. Now the wrongly recorded checks. Now remember, what is the difference between the difference between
I tasted very good. She said it was-
go ahead, difference between 1,920 and 1,380.
she had
1,920 and 1,380.
540.
540. Now, is this for the sedan company or against the account of sedan company, Sedona?
This is going to be against.
Against, yeah. So that's going to come under the deductions.
Yeah.
So
What would be the name for it?
so this is a incorrectly recorded check. Okay, so we're going to call it incorrectly recorded
Check.
check for how much?
540.
540. I'm going to put it right here, 540. Oops. F2 540. All right, what else we usually deduct other than the errors?
And
So this is an error.
So, insufficient check for $183.56.
Okay, that's correct. NSF check. SF check for how much?
$183.56.
180.52. 183.
183.56.
0.56. And what else do we have you noticed that we should deduct?
The service charge
Yes, sir. Bank service charge.
for $25.
Uh-huh. For
$25.
good morning. Good morning. Good morning. Hi.
Right, do you need any help?
No, thank you. We're good.
Okay.
Appreciate you. For $25? 25. So what is the total of all? Do you see, first of all, any deductions other than this that we can deduct? I think we use most of the,
We use all of them.
all of them, yeah.
We use all
So that's all the deduction. How much is their total?
$748.56.
How much?
$748.56.
748.56. 56. Let's hope we get a corrected balance that's similar to the balance per bank. So deduct this out of the 55. What do you get? 48.50 from 55 to 34.
54,485.60.
Exactly. Let me first put a line under this one, and tell me that again.
$54,485.60.
Are they correct?
Yes, sir.
Yes, sir. This is a corrected balance per book, and therefore they are equal. See this one here? Let me see if I can do this for that thing. All right, see, I put it between two in a square, and I put this one in a square also, and we're going to call that corrected balance per books, or adjusted.
Balance.
Adjusted balance per books. All right, I think they are equal, and this is an example of and a practice for a bank reconciliation. Now remember, who does this kind of job in the businesses, corporations? Somebody, maybe the comptroller, maybe the bookkeeper, maybe a general ledger accountant. Yeah, one of them has to do that. And remember, each account must have a bank reconciliations, and usually corporations have several accounts. All right? And it's a crucial item that a bank reconciliation must be done. Because especially if it's a public organization, and when the auditors come in, that's one of the important items that they first look at. And if you don't have bank reconciliations, that means you are not controlling your cash. And therefore you will see a red flag by the CPA firm. Okay, now we're going to go to chapter 9, the next chapter. And it is accounts receivables. If you notice, so far we have talked about controlling cash. Under controlling cash, we have learned the two major methods that we did, the petty cash and bank reconciliation. And then also we learned how to control inventory. You remember inventory, we learned inventory evaluation methods, specific identifications, average method, FIFO and LIFO. And then we have two methods that we use for estimation, and they are retail method and gross profit method. Now we are moving into another current asset, controlling other current assets, which is receivables. All right? What is receivable?
Money coming in.
Coming in from where?
Different from sales, I guess.
From doing business, correct? When you do business with your customers, you sell them sometimes things on credit. That means you have a receivable from them. What kind of account is account receivable?
Asset.
It's an asset. Is it long-term or short-term assets or current assets?
Current asset.
It's a current asset. That's correct. Now, you got to be careful as a business, especially like yours. You know, do you sell people on credit in your store?
They gotta pay for everything. Well, It depends if we choose to do so, we can, but it's not.
Well, don't you charge the credit card?
Oh yeah, we charge.
You
credit
know,
card.
so what is the policy toward using credit cards in your place?
When they credit card, they gotta have a signature. You gotta give a signature.
I mean, does the company give credit? Do they approve when you apply for a credit card?
Oh,
Is
when
it
they
easy?
apply-
What's the procedure?
When they apply for a card with
Yes.
us? No, we don't have that.
Ah, you don't have a card?
No, they
Ah, okay.
all the transactions we make, like they want to pay with their card, they gotta pay for their card for whatever amount that we charge them already.
Well, like JCPenney have their own credit cards. Dillard's have their own credit cards.
Those are like
Lowe has their credit cards.
like
I know,
big shopping store.
Walmart starting to have theirs.
Uh-huh.
They offered me to get one.
Yeah,
And you
those,
didn't get one?
No, I got enough.
those are big corporations like JCPenney. You gonna come back and you go like JB10 because they got a different type of item, clothing type. So
All right.
you could
So, I mean, you got companies have to be extra careful before they give credit to somebody. Yeah.
oh yeah.
And one of the things that I'm just thinking they would have, I think they on the application they will ask you some questions. You know, what is your annual salary maybe, and they'll look at your credit score too.
That's-
Yeah. So you got to be careful not to be too much lenient when you give a credit to customers or to other people, and you got to do the research. I don't know if you haven't done money and banking class yet, huh?
Yeah, I know the adverse selection. That's what.
Yeah, exactly.
Yeah.
Adverse selection. That means before you give credit to somebody,
You gotta make sure.
you
that
gotta
they're
make
not
sure,
going-
collect data. All right. Unfortunately, there is a portion of that receivable that is going to be uncollected. I mean, whether you like it or not, you know, not all customers are going to pay. 100% of them going to pay, and some of them are not going to pay on time.
Yeah.
All right. So these are called uncollectible accounts or bad debt expense. So the customers who cannot pay, their amounts will be called uncollectible accounts or bad debt expense. Now there are two methods of accounting how to deal with the uncollectible accounts. And one method is direct charge off, and the other one is allowance method. Now, when we say direct charge off, that means you recognize a loss and you write it off. You think this is not going to be collected. Okay? And the other method is the allowance method. You estimate certain portion of your receivable to be uncollectible. You didn't write it off yet, but you estimate that a portion is not going to be collected. All right? And then we also have another asset is notes receivable. That's also an asset.
Current asset.
A current assets, yes sir, and it is a promissory note. Okay, it's a promissory note. It's an unconditional promise to pay a definite sum of money on demand or at a future date. Remember, the difference between accounts receivable and note receivable are 2 points. There is a date, specified date where the amount has to be paid, and there is also interest. That's the difference between the two. Okay. The allowance method is an application of accrual accounting which requires estimated losses from bad debts to be matched with revenue they help to produce. So, I don't know if you still remember the accrual methods. Okay, where we have to recognize revenues against expenses or expenses against revenues in the period in which they are incurred. So if you have some allowance, if you determine that there is a portion is not going to be collected for the first quarter or the second quarter or third or fourth quarter of the year, they have to recognize that and record it. on that specific period. Okay. So, of course, why do they recognize that? Because there is usually a portion that management cannot identify at the time of the sale which customers will not pay or how much the company will lose.
But it always happens, though.
Yes.
Always.
So it will show on the balance sheet. All right, it will show account receivable less allowance for uncollectible accounts. Now, what kind of account is the allowance for uncollectible accounts?
Kind of counting it.
It's a contra account. C-O-N-T-R-A. Contra accounts. Okay, that is the opposite of an asset. It reduces the assets. Can you give me an example of a contra account that we went through, that we mentioned before?
Wouldn't that be- I wouldn't.
Go ahead, say it.
Nah, I know it's wrong, but I was like about like depreciation.
Yes, that's it.
Yes. Oh, okay.
That's it.
Alright.
Accumulated depreciation. You're going to say building less accumulated depreciation building. Or equipment less accumulated depreciation equipment. So these are contra accounts. Their balance is the opposite of the asset. They have a credit balance. See, the building balance is a debit balance, and then when you say less accumulated depreciation means it has a credit balance. The same thing for accounts receivable. You will see it on the balance sheet. Yeah. All right. When we say disclosure of receivable, what does that mean?
Disclosure means,
Any
accounting for it, right?
okay, a payee include. Well, I'm not going to go. Any interest accrued on the notes is also included in the current assets section as interest receivable.
Basically,
Like
when you disclose your information, that means you're telling.
yes.
everybody.
And the uncollectible accounts expense appears on the income statement.
That's
See,
awkward.
the allowance for doubtful accounts shows on the balance sheet, and then you have the uncollectible account expense or bad debt expense. It shows on the income statement because it is an expense. Yeah, is that the what's going on in the football, in the World
You see
Championship?
Barcelona.
Yeah.
You see Mexico beat Germany.
Yes.
That was crazy.
That's really great.
I was gonna put some money on that. I would have won thousands.
That is really great. That Germany is beaten. Yeah, I like that. And it's beaten by.
Mexico better not lose to no Germany.
Germany won the whole thing last time.
Yeah, Germany was the champion.
I'm looking for Brazil to win.
Oh, I love that too.
They got my favorite player, my favorite center. Yeah, Neymar on there too.
Anyway,
Killed Brazil last time, like 7-0.
let's move along. Enough about the. I think which one of the Arabs? I think have you watched early games between some Arab countries? And I know Saudi Arabia was out by which one gave them 5 goals or 0?
Oh,
Saudi Arabia 0 and the other guys got 5. Saudi Arabia spends lots of money on their players, hundreds of thousands of dollars they
that's
give.
it?
They spend on their.
That's considered cheap in soccer.
No, I mean hundreds of thousands. They give them cars, they give them salaries, they give them housing.
They only spend hundreds of thousands on each player.
No, and each player will get hundreds of thousands of dollars.
Most soccer players get millions.
I'm talking about, God knows how much, hundreds of thousands, yeah. Anyway, let's see. There are 2 common methods of estimating uncollectible accounts expense. How do we come up with, how do we estimate the uncollectible account expense? 2 methods. Percentage of net sales and accounts receivable aging method. Now the net sales method, what is net sales equal usually? Your gross sales minus,
Cost of goods sold.
no, what do you want? I don't know about net sales.
Net sales. Oh man.
Your gross sales minus sales returns and allowances minus sales discount. It gives you your net sales. Once you figure out your net sales, the management apply a portion or certain percentage of that to be uncollectible. So if we say our net sales are $100,000, and we say 2% of that is uncollectible. All right. Once you do that, you're going to debit bad debt expense, and then credit uncollectible accounts. Allowance for uncollectible accounts. You debit bad debt expense or uncollectible account expense, and you credit allowance for doubtful accounts. All right. Now the second method is the aging account receivable aging method. That means you will put your account receivables into different categories. That means
By the date.
the accounts that are not due yet, you put them in one column. The accounts that are 30 days past due in one column. The accounts that are 60 days past due in one column. 90 days, like that. So let me go back to for a second. And I tell you what I'm going. Let me do a different worksheet. All right. So you put your customers, and then you have not yet due, 30 days past due, 60 days past due, 90 days past due, and 120 days and over past due. So you put your customers. All right. Haven't you got any bills that says not yet due or 30 days past due, medical bills or any? Have you ever seen any of those? Or your electricity bill or a past due? Or from your credit cards, or so this one, let's say not yet due, and then 30 days past dues. Okay, and this one 31 to 60 days to 60 days past due, and 61 to 90 days past due, and this one 91 over 90, let's say over 91 days. Past due. And then here you put your customers. You might want to say Ali, oops. Oh, no, I guess we've got some protection here. Uh-oh. Oh, look where I'm putting that thing. That's supposed to be here. All right. Ali, Bailey, Darian.
My name spelled wrong.
Huh?
My name spelled wrong. It's
Huh?
L-E-Y.
Huh?
It's L-E-Y.
Oh, okay.
That's my last name.
Like that.
B-A-I-L-E-Y. Hey.
Okay. And brother
Graham.
Graham.
Grimm.
Who else? Ledbetter.
Don't want to date me,
Gonzalez. Jimenez. You know Jimenez? Isn't this okay? So let's say these are the customers. All right, and let's say Ali is not yet due. He owes $50. Well, let's say $120. Oh, what did I do here?
Made about 120,000 accounts.
What happened really? I mean, just to understand.
Oh, you went to. Is it at the bottom?
Yeah, I must have hit something. 100. Okay, 100. I must have hit something.
Every time you click on that, it's saying, you probably need to change your tools.
Huh?
You probably need to change your tools.
Change what?
Your tools that you use, whatever.
Yeah, but
You sure the number's not locked?
yeah. Oh, num lock. I hit the num lock, but there is lock screen. I think maybe. No, not lock screen. I must have hit something. Let's see. Num lock. Okay, 120. And brother Bailey, he is $300, 30 days past due. And Reverend Darian, he has $400 that are 60 days past due. And brother Graham, he has $200 that are 30 days past due. And Mr. Ledbetter that has $500 that are 90 days past due. And Miss Gonzalez that she has $100 30 days past due, and Mr. Jimenez has $200 that way are overdue.
You put it with Gonzalez.
Oh, 200. All right, let me put these centers so it'll be easier to. All right. Once you update your accounts with your customers like that, you add the totals. All right, and then you add across. All right. So these are the receivables updated. So now you are going to say, now what portion of these receivables is uncollected? You know, ask Brother Bailey, if we say these are not yet due, how much of it do you think will not be collected? What percentage you might give it as uncollectible?
You gotta take the other ones, and I'll
what portion of some account that are not yet due?
Oh, well, I guess it would be, since it's only 5, it would be 20%.
How much?
20%. You say percentage chance that it won't be collected?
Yeah.
20%.
We know nothing yet about it. It's not yet due.
Oh.
It's not yet due.
I think we was looking to the future.
Yeah, we look to the future. Well, if let's say I came to your place and I used my credit card
Yeah.
today, do you say immediately that maybe I'm not going to pay 20%, not going to be collected?
Oh, nah. All we got to be collected for it when you get your stuff. So,
Because you don't know yet. It's not past due. So I may give it a very small percentage.
okay.
I would say maybe 1%.
Oh.
Because since brand new yet, we know nothing. One, okay, uncollectible. So I'm going to put here uncollectible. This is estimated uncollectible. Oh. I'm going to call it estimated uncollectible. So 1%. How about an account that is past due? Like this, $600, that 30 days past due.
Well, I ain't paying 30 days. I'm not paying it at all.
Huh?
I ain't paying 30 days. I'm not paying it at all. So put that 0. 1.
So if I'm past due, if I have a customer that's 30 days past due, I should give up on him?
Nah. You never know what they going to do at that moment.
So I would say maybe 10%. How about a customer that is 60 days past due?
I give about 50% right there.
I would say 30% maybe.
Or 30%.
Or 4, yes. So you got a sense of it, yeah. 30%. How about 90 over 60 days? That's past due.
I'll give that one 50 for sure.
All right, okay.
That gotta be 50%.
That makes sense.
I give
50%. How about an account that is over 91 days past due?
Oh, that's 100%.
I'll go say 100%.
99.9.
I'll say 100% too.
Give it 75%.
75. If you ain't paid.
There's always a chance they may come back and pay.
Well, unless it's not notes receivable, because that interest gonna stack up. If you let it go over 90
Yeah,
days, it's
nah,
not gonna
that.
get paid. But since it's just that certain amount over that time, it might get paid. So I
That
would
interest,
I give it 85%.
that interest gonna always tax you.
Since you are insisting on
Get you over the heat.
100%, I'm a little bit optimistic, more than you guys.
Oh yeah, you're very optimistic.
So, what is the 1% out of? The next thing you do is you multiply the total by the percentage. These will be given percentages. Who comes up with these percentages? Usually, management or the people who are in charge of credit, credit policy. So, what is 1% of 120? Is a dollar and 20 cents.
20 cents.
Yeah, 1.20. All right, and who? Let me also put these hoops in the center. How about 10% of 600?
60.
60. How about 30% of 400?
120.
120. And how about 50% of 500? 250.
250.
Yeah. How about 85% of 200?
170.
170? Okay, now these are the amounts that we estimate that they are not going to be collected. The 120, 60, 120, 250, and 170. Now we add all of those. You add all of these. This is your your allowance for uncollectible accounts. This is allowance for, that's what your allowance for uncollectible amounts should be. So we updated the accounts receivable. That's called the aging method. We updated the allowance for uncollectible accounts. So on the balance sheet, you're gonna show accounts receivable less allowance for uncollectible account, which is $601.20. Now, how much of this 601 should be? First of all, before we say how much, we got to find out whether we underestimated or overestimated our allowance account. You're going to look at your previous balance of the allowance. You're going to look at you look at your balance sheet at the beginning of the year. Okay, let's say that your account received, that your allowance was, okay, at beginning of the year. Let's assume that the allowance, I just don't want to leave the word allowance alone. Assume that the allowance for doubtful accounts, or allowance for uncollectible accounts, what am I doing? Accounts is $620. Okay, at the beginning of the year, your allowance for doubtful account was $620. But when you updated it, it turned out to be, it was $601.20.
We underestimated.
So earlier,
Oh no.
it was underestimated. It should have been 620. So at the beginning of the year it was 601. Then when we updated it, it turned out to be 620. So therefore, our allowance account was short $20. We have to deduct more.
It was short $19.80.
Yes.
That was your fault, Dr. Lee. You wanted to give them people an 85% chance. We wanted to give them 100.
So what kind of journal entry we should do? We need to increase the allowance for doubtful account by $10.80, correct?
Yes, sir.
So what do we debit, what do we credit? Uncollectible account expense, so we're going to debit uncollectible account expense or bad debt expense for $18.80. $18.80, and we credit allowance for doubtful accounts. For $18.80. All right, so notice that we had to increase. We credited the allowance for doubtful account for the difference because it has to increase. All right, what happens if at the beginning of the year it was 580? Okay, let's assume at the beginning of the year it was 580. What's happened?
You said beginning of the year was 580.
Yeah, it should be 601, but we estimated 580.
So we overestimated.
No, we
Oh.
underestimated.
Oh, okay. See.
We underestimated. That means what? We have to deduct from the 601. We have to go down on the 601
It's $40.
for whatever the difference is. So we debit, in this case, we debit the allowance for doubtful account and we credit uncollectible account expense. So, in this case, we would have taken care of. See, this is the aging method. Okay, if you go back here for a second, the two methods that is for estimation uncollectible account expense are the first one, percentage of net sales. That means we're going to figure out what the net sales are. Your gross sales minus sales and returns and allowances minus sales discount. And we will have a portion. It's easier, a lot easier, but this one has the difficult one that we just did. Well, not difficult, it just consume sometimes. Because you have to update your receivables according to how late they are. Okay? And you do exactly like what we did with a minute ago. All right? We just did aging account receivable. Now, at some point when, especially the ones with after 90 days or after 120 days, you may give up at the account. When it's really clear that you are not going to collect that account, in this case, you have to involve accounts receivable. You have to involve, that means it's a reduction in accounts receivable. You would have to debit allowance for doubtful accounts and credit accounts receivable. You take it off from your receivable. And also, you're going to debit uncollectible account expense and credit accounts receivable, because it's an expense now. Debit uncollectible account expense and credit accounts receivable. All right? Okay, let's take a look at the notes receivable for a minute. Now, we're through with accounts receivable. Let's look at the notes receivable. Like we said, the difference between accounts receivable and notes receivable is two things. No, it has a maturity date. The note has a maturity date, and interest. Two things. Accounts receivable does not have these two things. So the first thing in maturity date is what?
The maturity date is the
If let's say it's
the date on which it has to be paid.
a 90-day note, and you started today. Today is June 18, and it's a 90 days note. So what is the maturity date in this case? Add 90 days from today.
Like September 18th, so July, August, September.
So count just 90 days, that would be the maturity date. All right? So the duration of the note is 90 days. Okay. if we were to determine the the duration, you're going to start from 18th. So in this month we have 12 days in June, 12 days in June, and 30 days in July, and 30 days in August. So that's 60, and 12, 72 days, and then we need the rest. It's going to be in September. That's how you need to look at it. Yeah. Okay. Okay. So what is usually the interest that we supposed to receive? Now, what is the formula for interest? How do we figure out interest?
The principal time.
Don't look there. From what we have learned before in other classes.
The interest is just like it's the cost of borrowing money or the return of lending money, basically.
Interest equal the principal times
Rate of interest.
times interest rate times what?
The length of it long
Time.
time.
This is the general formula for interest. The principal amount times interest rate times time. Now the principal amount is what? Is the face value of the note. If it is let's say if a note is $200, or let's say $500, okay, times $500 times, I'm going to put the this sign for time, okay, times, if the interest rate is 10%, times the time. So the time usually is out of 365 days. So you might want to say, if it is 90 days, then you're going to say 90 divided by 365. Okay? If it is, or you could say 3 months, or 2 months and a half, or 3 months point something out of 12. Alright? Either months out of 12 or days out of 365 days. So how much is that? Oh, times 10%. I added an extra percentage. I don't need that one. Equal. What did you get?
So I got 12.3287671.
$12.32 is the interest on this note. Okay? Alright. So, when it's time to collect this note, after exactly 90 days, how much you going to collect?
$512.
Yes, sir. $512. You collect the principal plus interest. Okay?
Collecting 32 cents too.
Yes, sir. All together, yes.
I need me. I might round.
You're going to collect $512.32. Yeah. Okay, what happens if you want to look after, let's say that we have 60 days past 60 days, we have to do figure out the interest for 60 days. Not for the whole period. Let's assume that after 60 days we have to close the books. And therefore we have 60 days worth of interest that we got to recognize. So how do we figure out the interest for 60 days?
Same thing, instead of the 90, just put 60 right there.
Yes, sir. Exactly. Yeah. All right. How about the sometimes, guys, the note is dishonored. What does that mean, a dishonored note?
When it's not paid on time at the maturity date.
Okay, here are some examples you can look at. Okay, just like what we did. So the holder or payee of a dishonored note should transfer the total amount due from notes receivable to an individual account receivable for the debtor. That means it's no longer you put it aside. It's no longer receivable. If it's dishonored, you're going to put it in a special account, for notes receivable. Okay. See, if it is dishonored, you put it aside. How much was supposed to be collected, and how much interest on it supposed to be. You gotta put it aside. All right. I think I'm going to hold on the use of accounts receivable ratio analysis until we do accounting 2, because we have a full chapter. So you see, accounts receivable can be used for the efficiency of the use of assets. All right. So we can analyze that if we want, and but there is one more thing that, guys, we need to mention. Financing receivables. All right, financing receivables. It's called factoring, though. What does that mean, financing receivables or factoring? I don't look there yet. Suppose, let me tell you, suppose that Brother Graham owes me, so I have a receivable from him for $1,000. All right? And I need the money really bad. I need money, I'm in direct need of cash. So what I could do, I could sell the receivable from him to you. And then you give me money. And then the receivable from me becomes receivable to you. Now, how does this happen? What's in it for you? You might ask, what's in it for me? If I'm going to put that burden on me.
It's just like $1 for dollar, so yeah. So like, you know what I'm saying? I give you my mom and get it right back from him. It's just like,
Well, if I were you, I wouldn't agree on collecting the whole thing. But I may, you may give me cash, $70, okay, and then
Interest, right?
either interest or fee. Fee. He needs to, because has to be some benefit for him.
Mm-hmm.
So you're going to collect the whole 100 from him. You only gave me 70, but you're going to collect the whole 100 from him.
I mean 700.
Yeah, 700, and you're going to collect the 1,000 from him. Yeah.
Okay, let's move.
See, there has to be something, but the thing is, can be with course or without recourse.
It's a loss for you in the end because you still losing out $300.
But I need the cash, so I'm willing to give up this much. Yeah, but if it is with course, that means if you cannot collect the 1,000 from him, you change your mind. That's with course. With recourse. Yeah, without recourse, once I send it to you, it's your problem, whether you collect it from him or not. Yeah. Okay? Mm-hmm. That's selling the accounts receivable is called factoring. Okay.
Speaking of principal accounting too, did you speak to Dr.
Yeah.
It's on
He said he will, but we have to look at the schedule and see if
yeah, they should have it out because summer 2 start next week,
next week
next Monday.
we're still 18.
That's ridiculous, but that's how it's got it scheduled. Like June 25th to start at summer 2, which is the last week for summer 1. So
We have one more chapter. I think will be done.
okay,
Yeah, one more chapter will be done. Yeah.
all right, I was just letting you
Yeah.
know.
I'm gonna the chapter of depreciation.
Open chapter 6 and all?
Huh?
6, 7.
Yeah, cause I was looking at it yesterday because you still need to open.
I got my work in the car.
I need that.
Yeah, that's why.
Yeah, I need that. Yeah.
Open the other chapters on the.
Don't
other
forget the homework too.
Yeah.
Cases, yeah. Because they're going to prevent you from making A or B. It's a 25%. Okay, so I think this is the that's it. And we have one more chapter. We will do some practice, a brief practice tomorrow, and then we'll start chapter 10, which will be the last. We're gonna talk about depreciation. Yeah,
Okay.
yeah, we're gonna talk about depreciation next time. I think you're gonna like this next chapter. How do you figure out depreciation? For the time being, I am the chapter 6 is open.
You knew this, okay.
I'm gonna open it 6 and 7 and 8. I'm gonna add 8.
Okay.
And now we have 9. So I'm going to work in the next hour, see what I can do to add those assignments. And I'm going to open the second exam too for you. So you can start working, yes, start working on it too. So let me take the roll here
You going
for the,
work out today?
Yeah, I be
What time you going?
I usually got like I be there about like.
okay, today is 6:18.
I got work till 10:30.
And we have Brother Bailey present and Brother Grimm present and Reverend Darian present. Okay, let me get out of this thing and stop streaming.